Gap trading is one of the best and easiest ways you can take advantage of price fluctuations on the share market to make a quick profit. Stay tuned. How's it going, guys? Ryan here with another episode of my trading guide, and today we're going to be talking about gaps, gap trading, and how you can take advantage of it. Before we get started, please remember to like and subscribe the video if you enjoy it. It helps me out so much, and leave any questions and comments down below. Now, let's get into it. So the first thing is, what is gap trading? Now, gap trading is effectively where you have 2 consecutive days of trading where the share price does not overlap in any way, shape or form on the daily chart. So for example, you might have a trading range on day 1 of 48 cents to 49 cents, and then on day 2 you may have 52 cents to 54 cents. And as you can see, there is no overlap in the value that is being traded based on share price. A stock can gap upwards based on a surge in demand, or it can gap downwards when there is a big dump and a big sell-off of the stock. And you can take advantage of both these different types of gaps in various ways, and I'll get into that at the later part of this video. Now, to give you a bit more of a visual representation of what gaps actually look like, I've taken this chart of a stock which contains both gaps upwards as well as gaps downwards. So as you can see, the first gap here is upwards and it's significant. You can see the price has spiked severely and there is a large gap in the trading price range. And as a result of there being no overlap from the day prior and that day in particular, you can see a gap has formed. Now, alternatively, if we move on to the second gap, you can actually see that there is a gap downwards and the price has dipped a little bit, but it has missed that trading range. And you can see the next day the price actually goes up to close that gap, and that's something we'll touch on in a bit. And the third one is once again another simple small gap up that you can see on the far right. Now, these gaps generally occur when there is some sort of a significant catalyst that creates a fluctuation in the value of the share. And this is generally either driven by good news or bad news that's related to the stock in particular, but can also be affected by the macroeconomics currently at play. A gap up will generally occur when there is good news, so the price skyrockets quite significantly or even just a little bit, and generally that's due to a catalyst such as good news, good results, profits being made by a company that were unexpected, mining grants being given, those sort of things that would cause a sharp increase in the value of a stock. Alternatively, you can have the opposite, and that is a gap down, and it's generally caused when bad news occurs, unexpectedly bad news in particular, which results in people wanting to sell off the share and get out quickly. Generally, this occurs in a dump scenario, not from standard day-to-day trading. Now, one key thing you need to consider is what I like to call false gaps. And effectively what a false gap is where it looks like there isn't a gap, but in actual fact there is. So for instance, let's say a share traded at 1 cent at its highest point on the first day, and then on the second day the lowest point was 1.1 cents. Now, there's not actually a gap in the sense of there's any value between 1 cent and 1.1 cent, but a gap is effectively when there is not an overlap in the value being traded. So there's no overlap. 1 cent wasn't traded on day 2 and 1.1 cents wasn't traded on day 1, effectively forming a gap. Another thing to consider is intraday gaps don't really matter too much. So if you're looking at a chart or hourly chart type thing across the day and a gap occurs, in the long run it doesn't really matter as long as the daily gap doesn't occur as well. So effectively that means if there is a gap in the hourly chart but there's no gap in the daily chart, then it's not really counted as a gap and is tended to be ignored. Now, you can have 2 scenarios with gaps, and the most popular one is gaps will always close. No matter what happens, a gap will always close. So effectively, If you have a gap up, the price will eventually come down at some point to close that gap and cover that trading range that wasn't covered previously. And likewise, if you gap downwards, the price will increase at some stage in order to close that gap. There are scenarios where this doesn't occur, but this is a bit more rare, and it's generally when a company has a really significant increase in the value of their stock. And these are known as breakaway gaps, and they never close because an announcement has come out and either the company is so successful or so unsuccessful that the trend of the price increase or decrease continues consecutively, infinitely, and effectively will never come back down or up to that price ever again. And just moving back to the prior point about gaps always close, there's no real reason for it. It's just coming down to traders' psychology, and everyone's got in their head that, okay, because the price has increased so much, it needs to come down in value, and vice versa. If the price goes down so much, it needs to come back up in value, and that's just due to the natural fluctuations of the market or in shares. Now, as a trader, how can you take advantage of gaps? And effectively, there are three key ways that I like to point out to beginners, which show you how to trade the gaps in particular. The first one is when you are not currently invested in a stock and the price rises sharply and you're expecting the trend to continue in the long term, what you effectively want to do is place a buy order at the bottom end of the gap so that you can take advantage of the fluctuation in price. It's gone up in value quite significantly, then it's going to come down in value to close that gap, and effectively what you're doing is buying at the bottom sort of price that it's going to hit or just beforehand. This means you can effectively take maximum advantage of the following increases in share price and make more profit in the short term. The second scenario is what I like to call the buyback scenario. So let's say you hold a share already and it goes up in price significantly and a gap is formed and the price continues to rise a bit and then it starts to dip. That's when you want to sell the share, and effectively what you're going to do is sell the share for a decent profit. The price will then come back down to close the gap, and much like the previous scenario, you want to have a buy order at the bottom of the gap to effectively accumulate a significant more amount of shares using the profits that you gained previously as well as the initial capital you had invested. For someone who doesn't have a lot of starting capital and wants to trade daily, this is a really great strategy because you can effectively increase the size of your position in a share quite significantly without investing any more of your own money into the share itself, and it occurs within a relatively short span of time more often than not. Now the final scenario, and this is for people who are more into short selling, and that's effectively when a large increase in price occurs, you want to short sell based on the gap that occurs. So you can see a gap's formed due to a large pump and an increase in value, then the price keeps going up. Then when you think it's going to peak, you short sell that stock. And effectively the price comes down, and then eventually when the gap's about to close, that's when you buy back that stock and you make your profit. Now this is a bit more of an advanced technique and I wouldn't recommend it for beginners, but it's always there to take advantage of that if you prefer to short sell, and it's another option that you can use to your advantage to make a quick buck. Now just to help you out, there are some additional factors that you should take into consideration to increase your chances of success. The first of which is to generally trade with the trend, don't go against it. So if you can see that a gap up has occurred in an uptrend, it's likely to then keep increasing value when the gap has closed. Whereas if you're gap trading and there's a large increase in value, a gap is formed and you're in a downtrend, it's possibly likely that when that gap does close, the downtrend is going to continue, and instead of buying at the bottom, you're effectively still buying at the top, and the price will decrease from that point onwards. So my advice would be to stick with the trend, particularly if you're buying based on gap ups. The second scenario is be careful of pump and dumps, because a lot of people can get caught out on them, and if you're not quick or careful enough, you can lose a large amount of money. For those of you who don't know, pump and dump is when the stock increases in price rapidly, and then when it peaks, there is a massive sell-off of the shares, and you don't want to get caught in that sell-off. So if you're buying and there is a gap that has occurred, you want to make sure you sell before that large dump in price occurs, if you haven't managed to get in at the bottom after the gap is closed. Then the third factor you want to consider is a dead cat bounce. And effectively what a dead cat bounce is, where the share price drops severely in value, then the price increases based on the bounce to close that gap up. So generally this is when it's going in a downtrend, and normally it occurs when there's been a really bad catalyst that's occurred. So the price drops sharply, but then it bounces up to close that gap, but then it will sharply drop once again. These are just some additional factors that you should consider before you purchase or sell a stock, because you don't want to get caught out on the bad end of any of these situations, or buy into something that's eventually going to go down in value when you thought it was actually a good purchase to make. Now that's all for today, guys. I really hope you enjoyed the video, and as I said before, please like and subscribe if you enjoyed it. It helps me out so much. And if you've got any questions, comments or queries, leave them down in the comments section below. And with that, have an awesome day, and I'll see you next time.